Hello there and welcome to my channel. So in this video, we are going to continue our discussion on interpretation of financial statements. In my previous video, we studied how to analyze the single entity financial statements, and so at the end of that video, I promised to make a video on how to interpret and analyze consolidated financial statements. So that is what we are coming to do in this particular video. Alright, so if this is your first time watching my channel, kindly subscribe to the channel and also consider liking the video if you find my videos useful. Alright, so let's get into it. So in my previous video, let me navigate to my previous video. So this was my previous video where I went through an ACCA past question. So this was the question we answered. We calculated some ratios, and then my focus in this video was to actually explain how to write your report, how to analyze and interpret your financial ratios. I said that you have to do I even given some tips for analyzing and interpreting the financial ratios. Now, today we are going to consider the consolidated financial statements. The difference between the consolidated financial statements and the single entity financial statements analysis and interpretation is on the interpretation and the analysis, because the figures have undergone a change. So we know that for the consolidated financial statements, they comprise of the financial statements of a parent and a subsidiary. So the parent acquires controlling interest in the subsidiary, and so there is that parent subsidiary relationship. The subsidiary can be one or two or even more. Alright, so if you want to know more about consolidated financial statements, kindly check out the consolidation ratios on my channel. Alright, so we are going to continue, and in this video I'm coming to guide you on how to analyze the consolidated financial statements in the exam. Alright, so you can be given a 20-mark interpretation question, which is a parent and one or more subsidiaries. Okay, so if that is given, then you will have a group financial statement issues that have to be analyzed differently than the single entity financial statement. And when a question involves the consolidated financial statement, you are likely to make some adjustments to the figures. You have to make some adjustments to the figures, whether through making adjustments to the consolidated figures, that is eliminating some intra-group transactions, unrealized profits, and other items, one-off items like that. Okay. So you have to make some adjustments in the financial statements to be able to get comparative figures. So when we are doing the analysis, you actually realize that of some analysis you have to do, or adjustments you have to do in the financial statements before you can actually get very good ratios for comparison. So that we do when you are analyzing consolidated financial statements. So in the case of consolidation or consolidated financial statement analysis, should consider the overall impact on the underlying performance of the individual companies if information about them is given. So that's what you are supposed to do. Now, the analysis usually involves two main issues when it comes to interpretation of financial statements involving consolidated financial statements. There are two main issues that we consider. The first one is the acquisition of subsidiary or the subsidiaries if there are more than one, and then the second one is the disposal. So we analyze consolidated financial statements from two main angles, or there are two main issues that you have to look at when you're analyzing. The first one is acquisition issues, and the second one is the disposal issues. Now, the acquisition issues. When it comes to the acquisition issues, we have three main acquisition issues. The acquisition of the subsidiary occurred at the start of the year, whether it was a mid-year acquisition or the acquisition occurred at the end of the financial year. So we are going to take each of these things, and then we are going to analyze them and see how they affect our ratios analysis. So first of all, you must understand that the ratios are the same. It is the analysis and the interpretation that are different. Hence, my focus is on the analysis and the interpretation, how to interpret your ratios and how to get the right figures for calculating your ratios. Alright, now what happens when a subsidiary when a subsidiary is acquired by a parent start of the financial year? And in this case, you are talking about the financial year of the parent, because this is the group. So the consolidated statements of profit or loss would include results of the subsidiary for the whole year, because we are actually buying. Let's say we buy the parent buys the subsidiary in January, which is the start of the financial, and the financial year ends in December. If that is the case, then the statement of profit or loss would include all the results of the subsidiary for the whole year, because it is going to start from January all the way to December. And so if that is the case, then we can analyze the financial statements normally. There are no issues. We will look at the mid-year and the end of year financial statements and consolidated financial statements or acquisition dates, and then you will see that there are actually adjustments that we have to make for those ones. So when it happens at the end of the year or at the start of the year, all you have to do is to analyze your consolidated profit or loss and other comprehensive income and the statements of financial position, and discuss the results or the ratios and the impact of the acquisition. That is all you have to do. So you must know that when a parent acquires a subsidiary, its expenses are going to be increased. The income will increase or revenue will increase. The assets and liabilities are going to increase, and so you analyze the results as such. Okay, so you only analyze the impact of the acquisition on the group as a whole. So that is what you do when the acquisition begins at the start of the year. Then when the acquisition happens what happens? The consolidated statement of profit or loss would include results of the subsidiary during the post-acquisition period, whereas the consolidated statement of financial position would include all the assets and liabilities of the subsidiary. Why? Because the consolidated statement of financial position happens or is prepared at the reporting date, and so because it is prepared at a particular point in time, which in this case is the reporting date, it will include the entire figures for assets and liabilities. So what this will do is that the ratios that use the elements of both the consolidated statement of financial position and the consolidated profit or loss will be complex, or they will include inconsistent or uncomparable figures, and so you would have to adjust the figures to be able to analyze the ratios consistently. Otherwise, the results or the analysis will give a false impression. Let's take, for example, we have the receivables collection period. Now, what is the formula for calculating the receivables correction? It is our receivables is calculated by our receivables divided by revenue. So divided by revenue multiplied by 365 days. So this is our formula for calculating our receivables collection period or receivable days. Now, the receivables is from the statement of financial position, whilst the revenue is from the statement of loss. So if we are adding the whole year's receivables and time apportioning revenue from the date of acquisition, assuming revenue is 100,000 for the whole year for the subsidiary, but we acquired the subsidiary mid-year, let's say June. The start of the financial statement is January, so we have January as the start. We acquired the subsidiary in June, and we are preparing the financial statements in December, which is the year end. So what is happening here is that if the revenue figure is 100,000, what this means is that because we acquired the subsidiary mid-year, which is June, we are going to time apportion this amount, which is going to be $50,000. Okay, so we have $50,000 here. Assuming the receivables amount is 80,000, sorry. So assuming our receivables is let's see 80,000 at the end or at the date of acquisition. Let's say that at the end of the year, what we are saying is that this figure or the dollars amount of revenue will be halved. That is because the subsidiary was acquired mid-year, so it will be halved, and that will be 50,000. So we are going to be using a half-year figure against a full-year receivables figure in the consolidated statement of financial position. So there is inconsistency. So what you are saying is that if a subsidiary is acquired 6 months, for example, a subsidiary is acquired the year, then only 6 month revenue, for instance, will be included in the calculation of our receiving period, whilst a full year's receivables balance will be calculation. So this does not only happen to receivable collection period. That means that our return on capital employed will be affected, our margins will be affected, and also any ratio that involves an item from the statement of profit or loss and the consolidated statement of financial position will be affected. So that is what we do. So what you have to do is that in your analysis, you have to connect on these issues within the interpretation. So when you are interpreting the financial statements, you have to make mention of these inconsistencies in the figures so that your results will not give a false impression about the analysis of the overall analysis of the group. All right, and then last one, which is the third one, is the end of year acquisition. Now, what happens when the subsidiary is acquired at the end of the year? what happens is the opposite of the start of the year. So what happens at the end of the year is that the statement of or the consolidated statement of profit or loss and other comprehensive income figures will not be used at all. So in consolidation, what we do is that we consolidate the income or the revenue and expenses from the date of acquisition. Now, since the acquisition happened at the end of the year, that is our reporting date, we are not going to include it because that is actually the end of the financial year. So what we will do is that we will not consolidate the revenue and expenses of the subsidiary at the end of the period. But because we are preparing the consolidated statements of financial position at the year end or at that particular date, we will still include the items of assets and liabilities in the group financial statements, and that will also give a false picture of the group. And so when you are doing your analysis, all you have to do is to reflect these increase in the assets and liabilities and an exclusion of the results of the subsidiary at the end of the period. Else, if you go ahead and do your analysis as normal, it will give a false impression of the group, and that will make your analysis wrong. All right, so this is how you deal with the acquisition issues. So we have an acquisition issue at the start of the period, mid-year acquisitions, as well as end-of-year acquisitions. Now, let's look at the second issue when it comes to the analysis of consolidated financial statements, and that is the disposal. Now, when it comes to the disposal, there are two main issues that we consider. The first one, the first one is the impact of the disposal on the financial performance. That is the statement of the consolidated statement of profit or loss and other comprehensive income, as well as the impact on the statement of financial position. So the financial performance, what happens? Because we are disposing of the subsidiary, what happens is that there will be one-off items such as professional fees, redundancy costs. These costs will be incurred in association with the disposal of the subsidiary, and so this will affect our profit figures for the period. Meanwhile, they are not going to reflect in subsequent years. It will only distort the financial performance of the group in the current year. It will not affect the figures for the previous year. So if you are given comparative figures, say 2020 and 2021 figures, and the disposal occurred in 2021, this analysis is going to affect the figures for 2021 but not 2020, and so you cannot actually compare the two the ratios of the two financial years, and that is going to give a distorted information. So what you have to do is to disclose these inconsistencies in the figures in the financial statement first, and then secondly, you have to eliminate these one-off items in your financial statement before calculating your ratios and then analyzing and interpreting the results thereof. And then the impact on the statement of financial position. What impact is it going to have on the financial position? So as we have for the statement of financial performance, the consolidated financial position will also be distorted. Why? Because ratios such as working capital is going to be skewed. working capital ratios or efficiency ratios, and we are talking about receivable collection period and all those items because they involve items from the consolidated statements of financial position as well as the consolidated statements of profit or loss, and so they are going to get distorted, right? So what you have to do is that you have to eliminate these one-off items in both statements to be able to clearly or correctly analyze your ratios. Even in fact, you have to eliminate them before calculating your ratios, before analyzing them and doing your interpretation. In addition to the one-off items such as the professional fees and redundancy costs affecting the consolidated financial statements, you must note that the assets and liabilities of the subsidiary that has been disposed of before the year end will not be included in the statement of in the consolidated statement of financial position at the year end or at the reporting date, because the subsidiary has been disposed of, and so as at the time we were preparing the statement of financial position, the subsidiary is no longer in existence, and so its assets and liabilities will disappear from our books. So that is going to give an incomparable figures with the previous year. Okay, because maybe in the previous year the subsidiary has been in existence, and so you will have way higher statements of financial position figures compared to our current year or the year of disposal. All right, so this is how you analyze consolidated financial statements. It is as simple as that. So the calculation of the ratios is the same. The only thing is that you have to do adjustments for the figures within your consolidated financial statement before calculating your ratios and interpreting them. And when you are interpreting, you have to make use of all of these that I have mentioned. All right. Then I also have a bonus content here, which is the analysis of the statement of cash flows. Now, when it comes to the cash flows do not actually have their ratios. So we analyze cash flows using the three categories of cash flow activities. And these include the cash generated from operations, cash generated from investing activities, and cash generated from financing activities. So we analyze them based on the items that make up these activities. So cash generated from operations, it is basically made up of our net profit for the year. You add back non-cash items such as depreciation, share-based payments, and then you also add your changes in working capital and all that. So those are some of the items that you are going to analyze. When it comes to cash generated from investing activities, the same thing. Cash generated from financing activities. So let's take, for instance, cash generated from investing activities. So let's say you have to be very careful stating whether the cash flows from investing activities is good or bad, because first of all you must note that cash generated from investing and cash flows from financial activities are usually one-off items. And so what happens is that you have to be very careful in saying that the cash flows are actually good or bad for the company. Let's take, for instance, a company is forced to sell off its assets in order to continue in business, and then after selling the assets, it rents them back. So you've sold your assets under a forced situation, and then you rented it back. So this is actually not a very, you rented it back in order to continue trading. Okay, in order to continue trading. So if that happens, you are not necessarily doing well as a business. And then also, let's take the cash generated from financing activities. Let's say that you have contracted a loan that you used to you have actually gone for a loan or a source of finance, which is actually in the form of loan, that is enabling you to continue trading, just continue trading. That is actually not a good indication for the company. But assuming you've gone for the loan, and then you use it to invest in assets, in cash generating assets or revenue generating assets, then that is actually a good impression on the performance of the company. So you have to consider all these one-off items in the investing activities and financing activities when you're analyzing your cash flow statements. All right, so that is how I bring my short video to an end. I hope you have learned how to interpret and analyze consolidated financial statements. All right, so this is my third and my last video on interpretation of financial statements. If you haven't watched my previous videos, you can go back, download them, and watch and re-watch them again. And I am sure after watching these 3 videos, you will be comfortable when it comes to ratios analysis and interpretation. All right, so thank you very much, and I hope you enjoyed the video. Kindly subscribe to the channel, and I will see you again in my next videos.